Hello everyone, in this video we will be doing the chapter number 18 of ACCA F3 Financial Accounting, and the chapter is called Incomplete Records. Before watching this video, make sure that you have checked the previous videos, and if you haven't watched the previous videos, go to the description. I have linked all the playlists. I have linked many playlists. I also have linked the playlist which contains the Kaplan exam kit solutions. So I've made videos of almost all the chapters, of which I'm solving the Kaplan exam kit, so make sure that you check that out as well. Now let's get started. This is a very simple chapter. Because we have done control account reconciliation and because we have done the previous chapters, this one is going to be really easy for you because we have covered this concept indirectly in almost all chapters. So we'll be finishing it in one video. Make sure that you have a calculator, a paper and a pencil. You need to solve the questions along with me and make notes along with me. What do you understand by incomplete records? You make a ledger account and you find the missing figures value. We have been doing this throughout the course anyway, right? So that's what we are going to do. Now, there are various ways using which you can find the incomplete records. The first thing is using the accounting equation. What was accounting equation? Do you remember what accounting equation was? Try to think about it. What was the accounting equation? Assets is equal to equity plus liability. That is the accounting equation we saw. So using this, we can find the incomplete records. So this is the first way, using the accounting equation. You know what the accounting equation is? Assets is equal to equity plus liability. Let's come to that. Using ledger accounts balancing figure approach. This is what we've been doing so far. When we used to make receivable ledger control account, what did we do? The balancing, after doing the balancing, we get the sales figure, we get the credit sales figure. And when we used to make the purchases control ledger account, the balancing figure, we used to get the purchases amount, right? So that is another way using which you can find the balancing figure. Using cash and bank summaries. So this is what we've done. We've done bank reconciliation, right? Using profit percentages. So we'll study about what markup and margin is. This is the only new concept in this chapter. Rest everything we have done before. Okay. When you are preparing a set of accounts, it is likely that you may have all the information available to you to complete a set of financial statements. It is likely that you may have an incomplete ledger or control account system. If this is the case, you will have to use the best information that is available for you and guesstimate any missing figures. There are a number of ways using which you can calculate the missing figures. The first one is the accounting equation method. So what is the accounting equation method? We will discuss that into the detail now. So the first method we are starting with, I hope you're writing it, which is the accounting equation method. So the first method we have is accounting equation method. So what is that? It is basically assets of a company is equal to the equity. What is equity? Equity is basically capital plus liabilities. Now if I want to basically, let's say if I want to expand the following equation, what am I going to do? What are assets? What are assets? Assets have current asset and non-current asset, right? So what is that? Total assets. So we're basically talking about total assets. What comes inside assets? Current assets and non-current assets, right? Now when we come to equity, what comes inside equity? Think about it. What exactly comes inside equity? Equity is the capital of a business, right? So my equity has share capital. We've done this in the previous chapter, the capital finances chapter. Share capital. The first component of equity is share capital. So the money which we raise by issuing shares, that comes in equity. So share capital plus retained earnings. What is retained earnings? We've studied that also. So basically the profit which is left in the business, which we, instead of dividing it, instead of distributing it, we are putting it back into the business. So we add it to the capital of the business, we add it to the equity of the business. So that is what is retained earnings. Okay. And other reserves, any other reserves you have, so reserves are always a part of the equity, right? Plus, now let's go to liabilities. Now what are liabilities again? Current liabilities plus non-current liabilities. That's it. This is the equation which we are going to be using to solve the questions if we have to solve the question using the accounting equation method. Again, what did we do? Assets is equal to equity plus liability. What comes inside assets? Total assets, right? Current assets and non-current assets. Now when we talk about equity, what does equity comprise of? Equity comprise of share capital plus retained earnings plus other reserves. These three things combine equity. And what about liabilities? Total liabilities, current liabilities plus non-current liabilities. That is it. This is the equation which we will be using in order to solve the question using the accounting equation. Simple. Okay. If a business entity has recorded very little information of this transaction, it may only be possible to calculate net profit for the year. This can be done using the accounting equation. So they have just basically expanded the equation the way I have explained. We could, however, expand this further to disclose each non-current or current asset or liability. However, that is not necessary as all this represents in the captions of the statement. Alright. So we don't have to expand every single thing. Like if I go into share capital, that in itself I can expand it even more, but we don't have to do that if we are given with the final numbers anyway. So now there is one thing which you can explain. Let's come to this one. What is this? Closing retained earnings is equal to prior year's retained earning figure. Prior year is basically opening plus or minus profit or loss. So if I have retained earnings and this year I made profit, I will add it to my retained earnings. If I made a loss, I will subtract it from my retained earnings. And whatever dividends I have to give to my shareholders, I subtract it from the retained earnings. That's what we have studied in the previous chapter. So by doing that, we'll be coming with the closing retained earnings. This was easy. I didn't discuss it because I thought this was basic, but I'll just write it for your clarity. So closing retained earnings would be opening retained earnings plus profit or minus loss, alright, minus dividends, whatever we are distributing, and then we'll be left with the closing retained earnings. Okay. By working out the, give me a second, I'll just erase this. By working out the value of the closing assets, liabilities and share capital using a valuation exercise, we should be able to work out the retained earnings figure. If we know the previous year's retained earnings from the last year's financial position, we should be left with the profit and loss for this year's missing figure. If you are given these values, you'll be able to find that, right? Let's start with my test understanding 1. What does it say? The statement of Andy Carp Company at 31st December 2008 shows the following balances. We have the following balances. Again, we are given the closing balances. Non-current asset, current asset. So when you add them, you get the total assets. Share capital. Okay, non-current liabilities and current liabilities. You add them, you get the total liabilities. The sales, purchases and expense records of Andy Carp Company has unfortunately been destroyed and the directors need help estimating the entity's net profit of the year so they can estimate its tax liability. The directors have informed you that the retained earnings of the entity closing were this much. So we've been given closing. Now just try to put it in the formula which we have discussed. Come on, try to solve it by yourself and then discuss it with me. Pause the video and then you can play it when you're done with your answer. Okay. Using the accounting equation. So total assets is equal to equity plus liability. We know that. What is the total assets? Non-current asset plus current assets, which is 10,000 plus 3,400, which is 13,400. Equity. What does equity contain? Share capital plus retained earnings plus retained earnings. Where's my share capital? Okay. Share capital is 200. What is retained earnings? Is it given in the question? Retained earnings is not given in the question. Okay. So in that case, what am I supposed to do? Think about it again. We are given retained earnings, which is closing retained earnings. And what do we really need? We need the profit. In order to do find profit, which formula are we going to use? We are going to use this. So we have been given closing retained earnings. Opening is not given, profit is not given, dividend is also not mentioned. So let's think about it. So the total assets is equal to equity plus liability. And now we know what liabilities and equity comprise of. And 31st December 2018 we need to find out. In the question, the retained earning is given of 2017, which means it is the opening retained earnings which is given in the questions. Now we have already discussed the formula. So we just have to put everything and find the value. We need to basically find the profit or loss. So what is the value of equity? Shareholders, share capital plus retained earnings plus other reserves, right? So the share capital is given in the question. It is 200. And what is the liabilities? The total liabilities is 3,800. So how do I find out my retained earnings? Let us look at that now. So there's a, and we also have 9400. What is 9400? Think about it. What is 9400? 9400 is my retained earnings. Okay. So that is my closing retained earnings. 9400 is my closing retained earnings. In the question, we have been given the opening retained earnings. So now the closing retained earnings is equal to the opening retained earnings plus profit or minus loss. So the profit is going to be 9400 minus 7350. That would give you this. That's it. So C is my answer. I hope you got it. Again, if you have any confusion, then check the formulas again and make sure that you are writing everything down in your notebooks. Again, so what are my formulas again, just to discuss it so that you don't forget it? Assets is equal to equity plus liability. What is assets? Assets is my total assets, current liabilities plus non-current liabilities. What is equity? And what is liability? Liability is also my total liability, which is current liability plus non-current liability. And what comes under equity? Share capital plus retained earnings plus other reserve. So this would give me my equity, right? When you add these three things, I get my equity. Now, if we bifurcate retained earnings as well, closing retained earnings would give you opening retained earnings plus profit or minus loss minus dividends which we are distributing to the shareholders. This would give you your closing retained earnings. So that's how we use the formula and we solve the question. Okay. Moving on. Now, this is the next method, which is the ledger account balancing figure approach. There's nothing for me to explain in this because this is something which you've done in the previous chapters as well. We used to make control accounts, we used to make receivable control account, we used to make payable control account. And balancing figure for receivables was what? Try to recall what was the balancing figure of receivables. For receivables, we used to say, and for cash and bank and cash in hand. So receivables was credit sales, payables was credit purchases, cash at bank is drawings, cash in hand is cash sales. So this is very simple. We have been doing this in all the chapters, so I'm not getting into the detail of the same. So cash at bank, we have a debit balance, we have a credit balance. Cash receipt would increase my cash, so I'm putting it on the debit side. Banking from cash in hand, so um, banking from cash in hand will again be debit. Sundry income will also increase, so debit. Cash paid, cash is going out. Credit expenses credit because money is going out. Drawings, money is going out. Money stolen is again money is going out, so then we get the balancing. Clear? Now, what is cash in hand? So the above one was cash at bank. So that was basically bank. But what is cash in hand? So it is the money which we have in our hand. So debit would increase the cash. Cash sales, cash is coming in. So debit. Okay. And sundry income, cash is coming in. So debit. Cash purchases, cash is going out. So credit. Sundry expenses, cash is going out. Banking, so when you're putting in the bank, your money goes out from your hand, so credit, and that's why we are showing it on the credit side. And then we have money stolen, cash is going out, and then we have the balance. Total receivables, so just related to the receivables ledger control account and the payables ledger control account, and try to use that in order to find this. So just try to use that logic which we have seen before and try to just apply that over here. So you have total receivables and then total payables. This is the same. Just recall the control account which we have done, and I'm not discussing in the detail because I'm assuming that you know everything. So what all I have discussed so far, these are the methods which I'm using in my questions. So we have total receivables, we have debit side and the credit side. Balance of receivables is debit. Okay. So this is a receivables account, but you can solve the questions using the receivables ledger control account. And just know that only credit transactions are always noted in this and not cash transactions. Let's take a moment to see this. Okay, we have test understanding too. So in this, you just have to make a receivable ledger control account and then you have to do the balancing. Okay, so we have starting receivables and then we have there were total receipts for customers of 55,000 and 15,000 was related to the cash sales and 40,000 related to the receipt. So we need to include only the 40,000 because we will only be writing the credit transactions. Okay, so as soon as you see this question, you need to know that you need to make a receivable ledger control account and come with the balancing. Very simple. You can do it by yourself. I'll just be discussing the question roughly and giving you a hint. Make sure that you check it out with me. Though, so the cash transaction should not be mentioned in the receivable ledger control account. Only the credit transaction should be mentioned. So when you're making a purchase payables account also, cash purchases should not be included in your control ledger account. Okay, so now I'm just solving the question. Make sure that you check them out and match it with yours. I'm doing it roughly. Coming to test your understanding 4, the following information relates to Ivor Bighead's business on 1st January. Electricity accrued, rent prepaid. So we have the opening balances and the closing balances, and we have the cash paid in the year. What are the charges of electricity and rent in the statement of P and L? What are we supposed to do in this question? We basically just have to make the expenses account. Simple as that. Don't get confused when you see question like this. We have already done how to make these. So just make an account whenever you see a question like this and you think you can make an account, just make it. So I'm making an expense account. Okay. And what did you do in expense? Think about it. This side had opening prepaid. This side had closing prepaid. Opening accrued. Closing accrued. Okay. So let's go to opening. 250. Opening accrued 250. Rent prepaid 300. Oh, oops. 300. What else do we have? Closing accrued 300. Rent prepaid 400. Okay. Cash paid in the year. So this much goes out of the bank, 1000 plus 2000. Debit expense, credit bank. That's what will be my entry. Money goes out of my bank. Debit expense, credit bank. So what is gonna come in my bank? 3000. P&L would be my balancing figure. Try solving it by yourself. I'm also doing. Okay, my answer is going to be 2950. So which one would be my answer? This is going to be my answer. Add this and see, it would be 2950. Okay. Next, so we're done with them. Now we're coming to the next way of finding, to use bank summaries and cash summaries. So this is something which is very similar to the ledger account approach. This method assumes that whilst data may be missing from the ledger accounts, a company can always reconstruct their cash inflows and outflows. Let's read the illustration now. During the year ended 31st July 2019, Collins Company lost some of its accounting data due to a computer virus. While it's managed to reconstruct elements of the financial statements, it needs some help determining the sales revenue for the year. So, just read this. The closing trade receivables. The closing receivables were taken from prior year's statement, which was this much. You have reviewed the list of receivables from the memorandum and calculated that the receivables outstanding was this much. After discussions with the management, you also determined shortly prior to the year end that 1500 of trade receivables were written off as irrecoverable. This has not been reflected in the list of balances or memorandums. To assist, one of the bookkeepers has reconciled the cash books with the bank statement for the year ended and calculated that 24675 was received from customers during the year. Cash till receipts confirm that 53435 was received during the year from cash sales. The remainder constituents receipts from credit customers. Again, you just make a receivable ledger control account. You know how to find the balancing, and that's it. I think you can do this by yourself, and the total sales will always include cash sales plus credit sales. Don't forget that at all. Also, one more thing, in the receivable ledger control account, only credit transactions are used. I have repeated this multiple times. Okay, now we come to the last topic in this chapter, and this is the only thing which is new. So now we have two things. The first one we have is markup, and the second one you have is margin. Always remember that margin is always on sales and markup is always on cost. Margin is always on sales and markup is always on costs. This is something you need to keep in mind. Okay? Margin is always on sales. Take a moment and write this down, and then we'll be starting with the questions. Okay, I hope you've written this down. Now, one more thing. If we're talking about, let's say, markup, gross profit is equal to markup percentage multiplied by cost of the goods. And margin, gross profit, if you want to find one, margin will be margin into sales. Okay, so markup will be on cost and margin will be on sales. Okay. Parroted O'Flaherty had sales of 1000. He makes a margin of 25,000. What is the cost of sales figure? What is the cost of sales figure? We need the cost of sales. We don't need the sales. Okay. So how are you going to go about it? Take a moment and try to think. We have a margin. Margin is on sales, right? So gross profit is equal to 25% of sales, gross profit on margin, which will be, so 250 is my gross profit. Okay, my gross profit is 250. Now you remember the formula, sales minus cost of sales will give me gross profit. So now we have the value of gross profit with us. And we have sales. So sales minus cost of sales will give me gross profit. So 250. So do the LHS, RHS, and you will be with C. I hope you got it. Very simple. Lorna McDuff has cost of sales 600. She applies markup of 25%. Markup is always on cost. Margin is always on sales. Very simple. So gross profit is 25% on cost, which is 150. So 150 is my GP, right? Cost of sales is this much. How much is sales? Sales minus cost of sales will give me GP. So sales is equal to 750. Very simple. So that's very easy. Don't see the book formula. They have complicated things for no reason. Margin is always for sales. Margin is always on sales. Markup is always on cost. Okay. And margin percentage into sales will give you GP. Markup percentage into cost of sales will give you GP. And sales minus cost of sales will give you GP. Okay, no doubt. Very simple. Again, same thing over here. This is the ratio. You can just ignore it. Okay. Jethro logarithm can tell you how to regard this business. So we have margin, we have opening, closing, purchases. Okay. So what is cost of sales? Remember the formula in the previous chapter. That's why I'm asking you to watch the previous videos, because every chapter is linked to the previous chapter. Opening inventory plus net purchases minus closing inventory will give you your cost of sales. Okay, by doing this you get the cost of sales, and margin is given. Not markup, margin is given. Okay, keeping this over here, let us first find the cost of sales. $800 plus 2840 minus 800 is going to give you 2840. So this again will give you 2840. So my cost of sales is 2840. Okay, and margin is also given. Let us take sales to be X. Both these equations are going to give you GP. 5% of X is going to give you GP. So X is equal to, okay, wait. This is GP, and X minus 2840 is also GP. So let's equate the two equations. 5 upon 100X is equal to X minus 2840. So this will basically be 2840 X minus 5 by 100X. And if you solve it, you will be getting sales. Okay, I hope you understood the logic, and now you can do it by yourself. Now we have question number 10. Jack Sprat provides the following information. Margin is given 20%, sales is given 1 lakh. So GP is going to be 20% of 1 lakh, which would be 20,000 is my GP. So 20,000 is my GP. Opening inventory, purchases, closing inventory is given. So what is cost of sales? Opening inventory plus net purchases minus closing inventory, which is 89,000. Okay. What is the cost of inventory lost in fire? So this is my closing inventory. We need to basically find out the amount which has been lost in the fire. Think about it logically. What are you supposed to do? I hope you've thought about it. Now I'm going to give you the entire solution. Okay. Again, what is the gross profit? 20% on sales, right? Which is going to be 20,000. Oops. 20,000. 20,000 is my GP. Any doubt in this? After that, what are we supposed to do? Find the cost of sales. Opening stock plus net purchases minus closing stock. How much is that? 89,000. Now tell me something. They have already mentioned that inventory has been lost. So what will be the cost of inventory? Sales. We are given sales. From sales, if we remove the cost of sales, we are given GP. So sales is 100,000 minus 20,000 GP. You'll get the cost of sales, right? So 1 lakh minus 20,000 will give you 80,000. So what is 80,000? 80,000 is my GP. So you already know GP. Okay. Now what are we supposed to do? You have GP with you. This is the cost of sales. 80,000 is the cost of sales. So sales, cost of sales is 80,000. Cost of sales is equal to opening stock plus net purchases minus loss by fire minus closing stock. Okay. How much will that be? $89,000, right? It will be 89,000 minus X. So the value of X would be 9,000. So the inventory lost is 9,000. I hope you got how I did that. Margin, sales. So I found out the GP. And from sales, if I'm going to remove the COS, I'll get GP. So using this, I'm finding the COS. And then I'm using the COS formula and removing and taking X as the loss by fire. So that is it. This is the last inventory. So how do you post the closing inventory? Debit inventory, credit P&L, easy. And then if it's insured, then what are we going to do? Debit insurance company, credit P&L. And if it's not insured, then debit P&L, credit P&L. If insurance is giving, then receivables will increase. If nothing is happening, then P&L. Okay. Fred lost his entire inventory in a fire. He unsigned insurance policy still in his unsigned insurance policy is still in his pocket of his good suit. Fred has supplied you with the following information. Based upon the calculate the value of inventory destroyed. Okay. So he has not signed the insurance. So he's not going to be receiving any claim from the insurance company. So markup is here, sales is here, opening is here, and purchases is here. How are you going to find out how much inventory has been lost? So markup is always on cost. Markup is always on cost. Right. You know that. So how are we going to find this? Think about it. Take your time and think about it. Okay. Let X be cost of sales. Okay. Markup of X again. Let's do something. Right? Clear till here? We have this equation, and we have this equation. We can equate the two and come to some kind of conclusion, and you'll get the value, and based on that you can calculate the value of the inventory which has been destroyed. You will be getting 1500. Try to do it by yourself. So that is it. We are done with the chapter. Gross profit margin is always on sales. Markup is always on cost. Okay, thank you.